space is just a physical location that can serve as an extension of our technology stack for commercial, enterprise, and government users. Starlink being the ultimate example of this, but also the government-owned and operated GPS constellation being another great example. As technology trends were accelerating on Earth, we felt like space's big opportunity was to become the silent infrastructure backbone of modern-day technology, whether as an individual consumer or company. They may not know that the technology they're interfacing with is actually relying on space tech and that it's actually on orbit. But the reality is that it can be a key input into driving growth or some type of new usage for consumers. So that was the unlock for us, just that observation, broadly speaking. There were tailwinds in terms of the cost per launch going down, the number of satellites increasing on orbit. There'd be knock-on effects and opportunities from that. But structurally, we understood and had a different view than most VCs. And that served us well in a lot of the first investments we made and why those have performed so well.
Jonathan, welcome to the Slice Pod, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You're the founder and general partner of Space VC, a high conviction pre-seed fund investing in frontier tech. You're now deploying out of Fund 2, which is a $23 million vehicle, investing in just 15 companies. So before we get deep into all of this, let's begin where we always do around here by asking, was this always the plan? Did you always know you were going to do your own fund at some point?
It's great to be here. Thanks for having me. Certainly was not a plan since childhood. Wasn't even aware of venture until my senior year of high school. I grew up in a small town in Ohio, and at the time, some Sequoia Capital former GPs left and started a new VC firm called Drive Capital, which is now well known, but at the time had this thesis around investing in the industrial heartland in the Midwest away from the coast. And that was the first time I was ever exposed to venture. My life was shaped very much from that moment forward by the startup and venture community. My parents, two educators, had never even heard of venture.
You started with a $3 million fund, but before that, you were a founder of your own company. How did it go from being a founder to actually jumping into building a vehicle of your own?
I've always been the type of person that once I decide on a path and direction and set my mind to it, I'm going to go in that direction through hell or high water. I started the company with a couple of classmates when I was in undergrad. I was very young. I went to college when I was 17. We started the company right around there. I ended up dropping out early sophomore year. I was a 19-year-old founder who was raising VC. We raised our first venture round, a couple $1 million when I was 19. I grew up in this industry with and around other exceptional founders. I was building the company in Boston and Cambridge at the time, surrounded by other exceptional operators, building all different types of companies. One of the main lessons I've learned in life is sometimes folks look for lessons just in directly competitive or very similar technologies. And what I've learned is you can learn from other founders and operators and trends in technology across broad swaths of sectors. Without going into too much detail of our founding journey, we had a great outcome. We, after 10 years, sold the company. We had raised $70-80 million of venture. We sold to Vista. And so it was an incredible outcome. But one of the detriments of that journey for me personally was a lack of personal impact. I didn't want to put myself in the box of being a software entrepreneur. The company we had started was in data infrastructure, in enterprise software, but I never saw myself as a software guy. We observed a problem in the world. I ran at it hard with some friends from college. We built an incredible business. We learned a ton. We had a successful financial outcome, but the vision was never to become a software entrepreneur throughout my entire life. My North Star has always been to run at the biggest, most important problems the world has and try to make a meaningful impact. The transition from founder to being a VC was an observation around opportunities in space tech and frontier tech where venture was not spending as much time. It was an observation that I felt could be taken advantage of by a former operator coming into the venture side, partnering deeply with early stage ambitious entrepreneurs who wanted to build companies, oftentimes their first company in these categories. And we're looking for a silent co-founder or an extension of their management team to help them through important and critical decisions in the early days. If you're a space tech company or a defense tech company, those early decisions around how do we position ourselves? How do we think about recruiting and hiring? When do we hire and when do we fire? Thinking about asset and resource allocation, go to market, building the first MVP, and when is it time to iterate and when is it time to double down based on customer feedback? Like, all of those trade-offs are incredibly important, and those are lessons that I've learned in my own personal journey and through the community of other founders that I've been surrounded with. So the decision to start the firm was both a act of courage to say, I'm willing to be a partner to these other founders in a sector that I traditionally did not grow up in, but that I was willing to be obsessed about and to learn as much as possible and to be a resource and a network extension for them. But also, it was a bet on the direction that I thought the way the world was going. It was a bet on where I thought venture could evolve and would evolve over time. And so the $3 million fund was essentially an act of courage to say, I don't care about the optics. I'm not trying to maximize the largest fund won.
There's almost two themes. One, you're trying to provide something that maybe you didn't get as much being on the other side of the table in that silent partner you were talking about. And two, doing it in a vertical that obviously it's interesting to you, but perhaps when you started working on this, underserved within the venture landscape. Things have changed. Obviously, in the last couple of years, this is becoming like a super hot space to be. What do you think really was the catalyst that got you to start this?
I think being passionate and intellectually curious about what you do is a prerequisite. And I knew through having accidentally starting a company with some friends and then spending 10 years on it, I needed to be really intentional about what I did next because these are really long-term commitments. Unlike some other VCs where this feels like the interesting optionality or VC as a lifestyle, I had really clear intentions coming in that I wanted to spend the next 20, 30, potentially 40 years doing this, and that the best in the business had made that type of time commitment. And so I was very eyes wide open on that. What I would say, though, is catalytic moment for me was I spent a lot of time. I'm a sponge. I'm not afraid to go and speak to hundreds of people, asking lots of questions, just trying to understand one or two nuggets from their journey and piece together this fabric and different data points of a viewpoint. One of the things that got me excited was this sense that the biggest barriers to success in space tech were evolving, where predominantly it was engineering or tech risk. It was emerging and becoming commercial risk. That excited me because many folks that had been spending time in these ecosystems, space just being an example of one of them, obviously we invest beyond space, were folks that were technically very adept at helping founders understand how to build what they were building, but maybe under indexing on everything else you need in venture and in company building. And I felt like I had the ability to bring a lot of those skills to the table, not to put aside the need for understanding the technical requirements of engineering design. I still every day spend time thinking about how to be a better partner to founders there. But I knew that the main value add and the risk profile was shifting. And especially for first-time founders who have a lot on their plate, we felt like we could be really compelling partners to those founders as they were starting.
I love it. We talk to a lot of emerging managers, and there is always the royal we that comes through, but it's literally just you, right? There is nobody else. How is it going from a company with hundreds of employees, tens of millions of revenue, and the day-to-day hustle of managing people to collapsing that entire structure on one individual in your little shack, context switching among a billion different things? How's that transition been for you?
In some ways, it's liberating because the success of the firm is on your shoulders in many regards. I love the challenge and the opportunity to bet on yourself in all facets. The ability to more directly influence the outcome of things sounds ironic because ultimately as venture investors, we're beholden to the outcome of companies we're not running. I'd say liberating because one of the things as you scale a company that can be frustrating at times is the people management, different layers, and the reality that you're only spending time on a handful of problem sets. Most of the time, those are the most important or challenging problem sets to be solving for. In some ways, it's liberating. I definitely miss the team aspect, which I think is part of the reason why I enjoy leaning in when we work with founders. A, because we're value add. B, because founders want us to be part of their inner circle of trust. But also, when you're running a venture firm solo, it can become a little siloed. I think it's important to have consistent ground truth of reality when you're working with founders. I really enjoy the founders that we support. Honestly, that's why I use the royal we, because this couldn't be further from an individual venture. This is a team effort. It takes a village to find these companies, to help them scale, to build them successfully. I use the royal we because everyone's involved. It's the people in the back office that are helping me out, the founders, our LPs that are introducing me to companies, or helping me think through strategic topics, informal advisors and friends of the firm. It definitely takes a village in this market to break into venture and have some type of consistent presence.
Frontier tech, it's more of a crowded space nowadays than it was back in 21 when you went solo. What was it back then, besides just sheer personal curiosity around this space, that made you think that this was an enduring thesis?
I don't think I saw it coming to this scale and scope. I think you can see trends. You can play out different probabilities. One moment that was actually a catalyst for a lot of this was after we started the firm, about a year and a half after, Andreessen started with their American Dynamism thesis. General Catalyst started talking more about their global resilience thesis. The war in Ukraine kicked off as well. And so I think a lot of these, even though they were focused more broadly than just space, it was a recognition that if you're investing in space, you're investing in defense. Those two are synonymous with each other. And so when we made the pledge to invest in space and to be dedicated to that, we were investing in defense. We were speaking to folks from the DoD from day one. What I would say is the conditions on the field in terms of the space sector were ripe for this to happen. And we felt like the caliber of talent that was starting space companies outpaced the caliber of venture investors at the time that was focused on those companies. We also felt like largely the existing venture dollars that had been focused in and around space and defense were misallocated. And in particular, they were misallocated because oftentimes when we saw let's call them generalist venture firms investing in these categories, it felt like they had to take a moonshot. And so you would often see asteroid mining, lunar exploration, and this is even predating the current space frenzy. To me, that felt misguided, not for the potential long-term impact, but just there's very little commercial viability of that being a venture return in the next 10 years. Space is just a physical location that can serve as an extension of our technology stack for commercial, enterprise, and government users. Starlink being the ultimate example of this, but also the government-owned and operated GPS constellation being another great example. As technology trends were accelerating on Earth, we felt like space's big opportunity was to become the silent infrastructure backbone of modern day technology, whether as an individual consumer or company. They may not know that the technology they're interfacing with is actually relying on space tech and that it's actually on orbit. But the reality is that it can be a key input into driving growth or some type of new usage for consumers. So that was the unlock for us, just that observation, broadly speaking. There were tailwinds in terms of the cost per launch going down, the number of satellites increasing on orbit. There'd be knock-on effects and opportunities from that. But structurally, we understood and had a different view than most VCs. And that served us well in a lot of the first investments we made and why those have performed so well.
We call it space for Earth startups. What does that actually mean? How would you explain it to a small child?
Space for Earth is where you have technology that's in space, but the usage of it is to make life on Earth better or more efficient, as opposed to leveraging space technologies to explore deep space. And I felt like that was a good positioning, and I'm glad you brought it up, because space for Earth, to me, even to this day, remains some of the larger opportunities within space tech. The companies that you see successful are oftentimes those types of oriented companies.
It's interesting because as you were talking about this, I kept thinking there is definitely something happening here. I don't know if it's like, if that's what he felt when we landed on the moon, but there is an orientation to the sky and there is more capital than ever becoming available for managers like you to deploying companies that are ambitious. Where do you think this goes long term? Do you think this is a fork in the road of the venture industry and where everyone will transition going forward?
I don't think space is for everyone. I would say the same for defense. While these are sectors that are interesting to the broader venture community, I don't think everyone should be investing in them. I'm supportive and appreciative of the level of interest, but I also think the opportunity set, not unlike all of venture itself, is very outlier driven. Our view has always been that there are only going to be a handful of generational companies in the space and defense ecosystem. You can argue what that number is. I think generational also heavily depends on your fund model, fund size, and concentration. A $1 billion outcome significantly moves the needle for small funds that hardly returns a fund for some of the larger funds being deployed now. This is all definitional and subjective to a certain degree. But what is not subjective is that there is a relatively limited set of opportunities for a relatively small and focused set of high impact, incredible founders to pursue. What I am excited about, though, speaking to the broader shift of capital, is I felt this as a founder. I was unclear if my worldview was warped, given that we were building an enterprise software company at the time. But even today, I still feel this way. Venture has overemphasized and over-allocated towards software and AI over the last 20 years and is a much less diverse industry in terms of what it chooses to back than maybe venture of years past. one of the things I am excited by is, and this is not to speak poorly of any venture firm that decides to focus on software and AI investments exclusively, but I think it's important to have a rotation of capital to back companies in these frontier tech ecosystems that are building at the intersection of digital or AI and the physical world around us, whether it's in robotics, energy and grid infrastructure, construction tech, defense or space tech. There are mounting challenges and problems, but also opportunities in the physical world around us. And that requires entrepreneurs to go and build physical hardware-oriented companies, oftentimes leveraging AI and software as a backbone.
How do you see competition, given that this is a much smaller set of winners or viable winners than your traditional application layer type of enterprise software cohort? How do you see competition within the early stages where you play at later on as well? Later on, hopefully, the winners will become obvious and people will still deploy capital there. But there is quite a handful of firms that are doing pre-seed and seed in this specific niche.
I see it as somewhere between competitive and collaborative. I don't see it as directly competitive, and sometimes it's not directly collaborative as well. Venture is incredibly competitive as an asset class, especially as you see multi-stage later larger funds moving downstream and spending more time in seed and early stage investing. The definition of seed and pre-seed investing has really changed, where people draw the lines for what a pre-seed round is, what a seed round is, what a series A is becoming more gray and blended. For us, what's really important is that we find exceptional entrepreneurs and we have the opportunity to invest $750K to $1.5 million in them at the right stage of their development. And if that's in conjunction with some of the other fantastic emerging managers that are building in this ecosystem, that's incredible. I love partnering and collaborating with many of them. There's a lot that I think we each bring to the table. When I started my fund one and came into the ecosystem, I was appreciative of how gracious everyone in that ecosystem was to new entrants coming in. However, that was not a 100% across the board experience. There were some folks that had extremely sharp elbows that were less than friendly when I began to invest in the category. And that really just stuck with me. It was very impressionable because I wanted to make sure that I was never that person to new individuals, whether they're earlier in their career or just newer to the ecosystem, that were coming and supporting companies. I view this as we're going to need all nation efforts to help rebuild these industries, to help find and support these types of founders building in these critical infrastructure, energy, robotics, et cetera, that we've been speaking about, especially in this near peer adversary world that we appear to be emerging in with China. And so my view is more is the better. Of course, there's a limited set of founders. There's a limited set of opportunities. We offer a very specific pitch to founders, and I think that has resonated, and that's why we've been able to partner with the exceptional founders that we have. But the reality is venture is much bigger, much more complex, more diverse, and it's impossible for any one venture firm to partner with every entrepreneur that finds success. I'm incredibly supportive of the emerging manager community. I've done what I can behind the scenes to help them raise their funds, share good deal flow, give feedback if asked to collaborate. At the same time, our focus is on finding founders as early as possible, oftentimes before they've started the companies.
Speaking about that, your first fund was 3 mil, 100K to 250K checks. And now you went up a size. You're doing like 23 mil, 750 to 1.5 million, which is a fairly concentrated strategy for the fund size that you're at. What was that transition like? What made you think going up in size, both check size and fund size, was the right thing to do at this specific point in time?
Founders were asking for it. And the number of founders that we invested in from Fund 1 would make a comment to me of, I wish you were X amount of the round instead of this other firm, or I wish you had been able to invest more so that I could finish the fundraising, go back to building the company. Oftentimes in Fund 1, we were investing not as part of a round, but just standalone on post-money safes as the first investor. As an example, we were the first investor in a company called Castalian. Very lucky to partner with Brian Hargis, who's just an incredible operator, came from SpaceX, is building a world-class company in defense manufacturing focused on hypersonics. I had the pleasure of being introduced to Brian by a colleague, and when we met, it was commiserate with the focus and kind of the thesis that I had around hypersonics. I just knew instantly that Brian was the team and the person to go and attack this very complicated, challenging problem set that the US needed. We wrote a check, but I wish that check had a couple of extra zeros added to it. Brian and I have joked about this. And it's just a long way to say, I always feel that the strategy on the field should dictate your fund size and your check size. I don't ever want to be writing checks that are larger or are a mismatch for the opportunity that we find in the partnership that we're seeking with founders. The check size we're writing today is the perfect size in my mind. It allows us to write a meaningful check for the first time founder or the founder who's looking to start a company and just wants $1 million or so to get up and running. It's collaborative with other emerging managers that are writing similar size checks. It's collaborative with larger stage firms that are writing smaller checks at the early stage and are looking to partner with sector specialists. That intersection is really where we've focused. Of course, in the future, as we think about growing the firm, the most important decision in my mind is how does the check size change the relationship?
And to the same tune, a fairly concentrated 15 portfolio construction model. We're a fan of it personally at Slice. We think that nothing better than emerging manager with that conviction and taking the time to diligence things thoroughly and measure twice and cut once. We find that most LPs don't think the same way. That we found that people are trying to push you to having more shots on goal rather than playing a concentrated model. And how do you defend that decision when this comes up, which I think inevitably does every now and again?
One of the benefits of venture expanding as an asset class and the LP base also expanding is that you're seeing more development of firms falling into one of two camps on the spectrum of conviction, high concentration funds versus diverse large funds. In our approach, we did not seek to convince folks that this was the better model. We had conviction that this was the better model, and we were simply looking for partners and LPs that shared that conviction and worldview. Part of the reason I share that conviction is because for early and pre-seed investors, when you start to do the math on the impact that a singular great investment can have amongst a portfolio of 25 to 30 versus a portfolio of 15, it becomes very clear that the limiting factor there is more about, do you have enough confidence and conviction that you can find, win, and support a company that has the caliber to be one of your 15? And I also find with funds that are writing much smaller checks in much larger strategies, it changes the way that they need to interact with their companies, obviously. When you're managing a portfolio of 40, 50 companies, you can't possibly be as deeply involved as you are when a founder is one of 15. When I invest in you, and we only make 3 to 4 investments a year, you are getting everything from me. I am deeply aligned and committed to your short and long-term success. I find that unwavering support is deeply beneficial in what founders are looking for. In venture today, sometimes it can feel that it's a lot of signaling, it's a lot of support if this other big logo firm supports you, and we're trying to take a totally different approach to that. One of the other things that excites me about high conviction funds is in venture, especially in frontier tech, when you look at the incredible missions that these founders are on, but then you start to break down the obstacles that each of these companies has to persist through and the adversity in order to find success. I like to flip the model and think about it as, what are the fewest number of things that I can get right about a trend that's happening in the world or a conviction bet on a founder profile or a talented team in order to have 1 to 3 times turn on the fund itself. And that excites me to an irrational level in terms of finding and seeking that concentration. If you look at Founders Fund as a great example and the success they've had recently, they have no concentration limits. And I think what that speaks to is both the benefit as a VC manager when you find a talented entrepreneur, the conviction and courage it takes to continue to double down and the benefits that can have from both an LP and a GP standpoint. I think the really honest reality is if you go back in time and index every single year and look at the truly exceptional and world-class companies that were started, it's not an extremely long list. We've built a strategy at Space VC where we've been able to partner with that caliber of founder early on. It makes sense to have a concentrated model and spend a ton of time with them as opposed to making them one of 30 companies in the portfolio.
You hold a little bit of reserves, right?
Yeah, 15%.
Why?
We do not pursue a pro rata strategy. We are looking to crowd capital into what we deem to be the 2 to 3 best performing companies. Oftentimes at seed stage, that's when we're doubling down. We're not waiting for a Series A or a Series B to materialize. Now, what we have executed several times and we will continue to do in the future is in partnership with our LPs, one of the requirements that we were looking for is an interest to co-invest and to continue to support some of the exceptional breakout companies. And so I can speak about it now because it's public, but one of our companies in Fund 1, True Anomaly, just announced a really large Series C They closed $260 million in funding. They're an exceptional world-class team. Our name was on the press release as having supported that round. It was probably the fourth or fifth time that we've invested in True Anomaly in partnership with an SPV, with some of our LPs, that we're able to not only through our support gain access to the round, but underwrite the company, understand the traction, understand the opportunity set, and still determine that even at Series C, there presents a more than 10x opportunity from here. And so for world-class founding teams, and True Anomaly is certainly one of those, we do have the opportunity to continue to support them in the back half of their journey, even when it's beyond the fund mandate or the reserves mandate of the fund.
How does the firm scale? Is it going to be multiple of these 20 million small high conviction vehicles?
The most important tenets for me are to be deeply involved in exceptional founders at the earliest stages of inception, often pre-inception, in these frontier tech categories. That's where you'll see myself and Space VC play for a very long time and be synonymous with that category. The mechanism in which we do that may shift and adapt to the times. It's too early to say exactly what that is. I do think that there is co-GP risk that you see more and more of these days in venture. And I'm deeply aware and thoughtful of that, just having been through a founding experience of my own with a co-founder who I consider to be a brother, but we lost a co-founder along the way as well. And so I'm just very aware that these are decades-long commitments, and you need to find a really special person to consider bringing on at that level. So at this time, I don't think the strategy or the firm needs to do that. If anything, I think being a solo GP is actually a feature, not a bug of the strategy right now. It allows us to move incredibly quickly. It allows us to move with high conviction. And it also allows us to make sure that entrepreneurs feel like they're always getting the very best from us, as opposed to layers of management or bureaucracy. If I wanted to manage a lot of employees and build massive teams, I would have gone back and started another technology company, not a venture firm. And I actually think one of the challenges that venture has as an asset class today is that it's a craft business that people are trying to scale. And so we want to continue to be the best at our craft, which we perceive to be pre-seed frontier tech. And so we'll continue to double down on that. But I don't necessarily think that scale has to be part of the equation in terms of teams or fund sizes beyond what is right fit for the strategy you're pursuing.
So it could go bigger just like according to natural inflation, but it's not the goal to necessarily become a capital aggregator like the American Dynamism Fund or stuff like that.
I think there's a natural evolution where firms have the right to exist and founders have voted by inviting them to be on their cap table that an increase in check size is warranted. But I think that caps out at a certain point for every fund, depending on what your strategy is.
On the LP side, how did it go from graduating from that 3 million vehicle to this one right now? Did you see churn within that base? Do you think that the ones you have right now are going to be aligned with the strategy they're talking about? Or do they expect a certain rate of graduation? Like some of the very large capital aggregators on the LP side want you to go bigger because they have more money to deploy. They wouldn't necessarily be interested in a manager that doesn't scale their AUMs if they're successful at what they're doing. They have a limited number of decisions they can make in a given year, and they want to make sure that this becomes like a very long-term strategy that can deploy a lot of capital versus something that gets capped over time.
Our Fund 1 LP base, I will forever be grateful for them because I consider them almost an extension of the founding and the opportunity set that we're now pursuing today. These are folks that also took a high conviction, high risk bet on an individual like myself, first time fund manager, investing in sectors that I didn't traditionally have a background in. No angel investing track record, by the way. I was, for most of my career, was a broke founder before we exited. So didn't have the capital to be doing angel investing into friends, although there are a few that I wish I had backed. With that said, a lot of those check writers were individuals. They may have been investing out of their family office because they had a family office, but there was no fund of funds. There was no large family office strategy. There were certainly no endowments or pensions or any foundations. And so the LP base was always going to have to evolve. And so while many of them did participate again in Fund 2, and especially the ones that I deemed to be exceptionally strategic to our long-term vision, 96% of Fund 2 capital was net new. And that was intentional around finding partners that shared in our high conviction vision, wanted pre-seed frontier tech exposure, and had conviction in myself as a GP, the firm, and the strategy we were pursuing. The LPs that we brought on board have been with the intentionality that we can grow and scale with them, but also that they can grow and scale with us. I think what we will continue to underwrite is always with the North Star being what is best for our founders, what is most strategic and helpful for our founders, and then backing out from there. We'll continue to have conversations with new groups and increasingly more institutional LPs as we scale the firm. But that's always how we're approaching it. Not just to be opportunistic because someone has knocked on the door. We try to be really thoughtful about what the concentration and makeup of that is. Personally, I value the really small checks just as big as the large checks. They serve different purposes. There are different roles. There's a different relationship there. But one of the 3 investments that we've made in Funds 2 has come from an LP introduction. That was one of the smaller checks in our LP base.
I'm sure there is a big component of it that is a word of mouth network. You got to talk to Jonathan because, et cetera, et cetera. And there is the LP here and there that will toss you like, hey, what about this guy? Do you want to talk to them? But do you have a structure about sourcing that you can follow? How do you get to pull the trigger on stuff that like, it's very imaginative in terms of like technological opportunity, especially from somebody that maybe doesn't have a background in space technology, jet propulsions and whatnot?
Because venture is also very much a copycat landscape. We think about sourcing deeply, and we have systems, relationships in place, inbound, outbound partnerships that cover a lot of different bases. What I would say, though, is I'm constantly underwriting and obsessed with the quality and diversity of our deal flow sourcing. That is something I spend a significant amount of time continuing to invest in, because as a manager, I think you need to. Talent pools are shifting, opportunities are shifting. And so we are not reliant. Sometimes you'll see these firms that spin out and are heavily based on the alumni network of one individual company or one venture firm. And I love many of those folks. So this is not a critique, but my view is that it serves a manager best to always be underwriting, re-underwriting, and finding new talent pools to invest in and to partner with. And that's the approach that we've taken to sourcing. So it's highly dynamic. On the evaluation side, I think at pre-seed, what sometimes gets lost is that first and foremost, this is a people business. And evaluating founders and the capacity of founders to grow, execute, and accomplish these highly audacious visions and missions is extremely subjective. But there is a structure and rubric, framework, pattern recognition, and a skill set that goes into identifying those traits, unlocking those traits, and having candid conversations in a way that maybe not all other VCs can have. And I think that's where one of the benefits of being a former founder, in my experience, is I can really level set with a founder in a unique way, even if our journeys were different, even if we built slightly different technology companies. I don't have a degree in anything, but I am deeply intellectually curious and obsessed about the problem sets that we're pursuing and our founders are pursuing, and have the ability to underwrite that in a unique way based on our obsessive ability to continue to learn, iterate, and experience those things, both ourselves and through our founders. When we evaluate a pre-seed company, we're looking for 3 things: the founder and the founding team, the market in which they're playing, and risks of the technology roadmap or the product roadmap. And without going into detail on each, one of the things that I think is really important and a benefit of being a sector specialist is you've just had pattern recognition across a broader set of companies in a very similar space around what has tried, what has failed, and why it's failed, or what is pushing the limits of where science or physics and R&D are today, and what is purely engineering execution risk. As an example, to oversimplify it, building and launching a satellite today, just a pure standard satellite bus, there's engineering risk, but you're not taking net new risk per se. Even if there's a new subcomponent, there's always some degree of risk there. The point is more of that assessment is on the commercial opportunity and is on the team and in the market that that satellite bus is selling into, as an example, or what it is servicing. I just use that as a small example to say across a broad set of opportunities that we're evaluating, first and foremost, it comes down to people. I spend an inordinate amount of time thinking about markets and having a prepared mind, and we incubate ideas and think about things pretty thoughtfully internally in terms of how the system is designed, how the engineering risk is actually accomplished. Most of the time, that diligence, we feel comfortable doing it in-house. This week, though, as an example, we're diligencing a company. It's in a sector that I've had less exposure to than other sectors. I'll pick up the phone. I'll do cold outreach. I've spoken to 4 or 5 experts in the last 24 hours, and I'm very grateful for their willingness to be able to speak. But I think our ability to augment any blind spots quickly and efficiently without over-diligencing something, because that's the other thing, is that pre-seed, at the end of the day, oftentimes it's a people bet. And so there's risk. These products change, these markets change, the technology and how they're pursuing it change. And so I think you need to take more of a top-down view as opposed to getting really overly innately focused on one individual component of market or proposed customer set or the particular engineering approach of this technology today. You want to make sure the team and the founder is rational that they're pragmatic in their approach, that they have a thoughtful understanding of the risks. And oftentimes we're betting on great teams and technical teams to go and figure that out.
Let's get a little personal for a moment as we kind of come towards a close. And a couple of conversations we had, you mentioned that one of the hardest part for you that you did not expect as going into this was the juggling of deploying the fund while also raising the fund at the same time. What are the hardest things about doing this specific play that you are on right now? Tell us a little bit about the hardships of the solo GP life.
By definition, as a solo GP, you need to be a world-class Swiss Army knife. You mentioned some of them, right? From sourcing and building a brand and building a firm, and understanding your own underwriting framework and evaluating founders and technology companies. I think way too little effort and emphasis is placed on value add. And so I don't even use the term value add. We think about it as deep, meaningful partnerships with our founders. I spend a significant amount of time with our founders. Ultimately, their success begets our success. One of the things I didn't appreciate, perhaps, for listeners contemplating starting a fund is the amount of operational rigor and back office administration takes place. Right? I did do most of that myself for Fund 1. I decided to partner with other folks for Fund 2 to pursue that. And certainly it'll only increase in burden as we become an audited firm, as the amount of unique vehicles we've raised continues to diversify, as we're distributing capital back to LPs. If I could do it over again, I probably would make the investment earlier on to bring on folks that could help stand up and institutionalize and mature the back office of the firm. We're at that point now, but it wasn't the case on day zero. I do want to underscore something. This is not hard compared to being a founder. I was a founder for 10 years. It was the hardest thing I've ever done in my life. I worked 100 hours every week, probably leaned on the emphasis too much of working hard compared to smart at times as a young, raw 22, 21-year-old founder. The true hard work is being done by the founders. I just want to emphasize that and make that clear. But in the context of being a VC, the hard part is, for me, in order to fully give 100% of everything I have to founders that I'm evaluating, I need to be encompassed in their worldview. I become obsessed with the problem set that they're pursuing. And oftentimes I have a very prepared mind for those conversations compared to other VCs. But even then, I seek to have a depth of understanding. The context switching between disparate technologies and industries, founders and opportunity sets, sometimes causes me to pause and go for a walk and clear your head. But I also know that the best VCs are constantly juggling this as well too, even amongst a singular industry. One of the things I thought was misunderstood was when we were, and to be clear, we're obviously not just focused on space now, but at a time when we were more focused on the space only opportunity, I would often remark at how diverse the challenges and technologies and ecosystem within space and how incredibly different underwriting each of those different technologies was, let alone being a generalist and being a VC and having the audacity to think you could be an expert at every possible technology in every possible sector. I think I approach that as it's a privilege to constantly be on these learning journeys, to be a thought partner to founders. But I do think sometimes, especially with the advent of AI, consumer applications that can help you synthesize and go through more material more quickly, I find the context switching is still the most fun and sometimes the most challenging part of the job.
I can tell you've been a founder, because it's a single piece of advice I got the most from mentors, board members, and founders that were like 2-3 steps ahead of me. And also the single piece of advice that I have been passing down to my execs and middle management as things starting to get really busy. And everybody's like, I'm burnt out. It's like, okay, let's go through this. Build a list, start with the small rocks, yada, yada, yada. What did we miss? What is the question that I didn't ask you that you're going to walk away from this recording and be like, I've been preparing with my comms team all week, and this is the message that I had to relay to the audience, and I didn't have an opportunity to share. What's that nugget of wisdom?
Well, first of all, you're looking at the comms team, so it was a brief regroup in advance of the session. I would just articulate where my head's at today and where we're spending a lot of time. I'm spending close to 90% of my time when I'm evaluating net new companies in the fields of energy and grid infrastructure and robotics today. Many of the founders and talent ecosystems that we've been spending time in that historically may have been starting space and defense companies are starting energy, infrastructure, generation, storage, transmission, or robotics use cases, oftentimes around industrial automation. We are spending a lot of time in those ecosystems, and we are on a listening tour to interact with as many folks as early in their journey in those categories. I think you'll see from our Fund 2 a handful of investments there. We've already made one, Carmen Industries, a thermal energy company, which is doing exceptionally well.
Awesome. Sir, thank you for your time. This was great. Thank you for walking us through your experience, your story, your journey, and dedicating a piece of your afternoon to Slice.
You've just listened to another episode of Slice, the podcast for emerging managers. Thank you so much, Jonathan, and thank you to Evan for introducing us to Jonathan. Next week, we're joined by Vivek of Supercharge. Probably sounds familiar because he's the co-founder of Superhuman. He's a 3-time founder, now investing full-time into early-stage technical founders as their product founder whisperer, unbundling the PMF machine. You're truly going to be missing out if you don't tune into this episode. Make sure you're subscribed to our Substack so you're notified when it drops.